Hello, I'm Adam Grimes. It is February 4th, 2015, and this blog first appeared on my blog at adamhgrimes.com. If you want more information like this, check out my blog. You also can follow me on Twitter at adamhgrimes. So today I want to take a look at fading a trend, and specifically to look at oil. One of the questions we get all the time is, where do we want to buy oil? Where do we want to buy oil stocks? How do we think about that? And let's take a look at that. First of all, in broad terms, how markets trend, how those trends tend to end, and then we'll actually look at oil and see what's going on there. So I would suggest with any analytical approach to the market, we have a few goals. First of all, you want it to be simple. You want it to have as few moving parts as possible. There are a number of reasons for this. For one thing, analysis paralysis is a real thing. If you have 13 different indicators you're looking at, it's always possible to find a reason not to do something or to do something, and we just don't know what to do. Now, on the other hand, we could simplify too much. So we want to have something that respects the reality of the market. And this could be, frankly, a lot of the things that people use, like Fibonacci ratios, for instance. I've done a tremendous amount of quantitative work that shows there really does not seem to be an edge there. The market doesn't seem to move like that. So very simply, what we do needs to respect how the market usually moves. And at the end of all of this, we should have something that is reproducible. In other words, we should have a methodology or a tool or something that we can use over and over again. So with that in mind, let's think a minute about how markets usually trend. And I will use, just for sake of argument here, I will use a downtrending market since we're going to be talking about crude oil, and we'll look at how that trend might end. Now, trends typically move in alternating bouts of with trend strength with retracements in between. So that's always the pattern. We have a trend leg down, and then a bounce, and a trend leg down, and a bounce. And of course, these patterns can be, I'm oversimplifying, these patterns can be quite complicated sometimes. And we can have things that look like the market the trend is coming to an end, and then the trend just simply continues. So there can be a lot of subtlety, but it pays to step back and think about the big picture, which is that markets move in alternating periods of with trend strength and then counter trend. So what we need here, before we can think about fading this trend, I think one of the great truths is, and this might come from Larry Williams, I don't know who I heard say this many, many years ago, but if you think about catching a dagger, you don't try to catch a falling knife. The right way to catch a falling knife is you let it hit the ground, you let it quiver a little bit, and then when it stopped moving, you reach down and pick it up. And that's basically what we're looking to do here with the market. So the first thing is we need some reason to look to look to fade a trend. And I'm going to talk about buying down trends. Everything is surprisingly symmetrical in markets. There may be some psychological differences, but you can just pretty much, if you're looking to fade a runaway uptrend, you can pretty much turn this around and look for places to short that uptrend. So if we're looking to buy this downtrend, the first thing we have to do is to have a reason to buy. Now, we'll look at some things that aren't reasons to buy. We think it's gone too far. It's overbought or oversold in this case. There's a momentum divergence. These things are not reasons to buy. What are legitimate reasons to buy? Well, to make it very simple, we want to see some break in the trending pattern. And what we can have here is really one of two things. You can either have a bounce that is very much out of character with the previous bounces. Now, there's a little bit of room for interpretation here because, as I said before, these patterns are complicated. But what we want to see is some fairly decisive evidence that something has changed in the market and that this leg here does not really look like the previous retracements. Something is somehow different. The other thing that we could see is a market that is trending, and then that trend accelerates and we would say goes parabolic or becomes some type of climax. We're not really going to talk about that today. I've talked about that in other places, but these are the two patterns. Either you want to see some evidence of climax or some evidence that the trending pattern has changed. Now, with that in mind, let's take a look at crude oil here. So this is a continuous chart of crude oil futures, and if you're not familiar with that, what happens when the contract expires, the previous prices are adjusted. So the price you see here at the right of the screen is the current price. What you might see back 6 months ago could be a significantly different price. Let's just look at a few things here. So people talk about momentum divergences. The problem with this is they happen quite frequently, and I will highlight some very typical momentum divergences here. And these are cases where price makes a new low, but a momentum indicator does not. And what this is traditionally supposed to show us is some evidence that the dominant group is losing control of the market. So anytime we have a situation where the market makes a new low and a momentum indicator does not, then we have a potential for a momentum divergence. Now, this is not a concept that I use, and we have some back here earlier too. I think actually maybe we don't. This is not a concept that I really use in my trading for the simple reason that I've not found it over the course of many years of trading. I have not found it to work that well. I've not found momentum divergences to be reliable. Strong trends make momentum divergences and roll over them. If you were looking to buy this market, every time you had a momentum divergence, you would have a problem. So that is the first thing that I would encourage you to take with a big grain of salt. And a lot of people look at these. Maybe people do find value. Personally, I haven't. If you're going to use them, then make sure you know what's going on. The second thing to look at is an oversold indicator. This is a standard 14-period RSI, and I have my overbought, oversold bands at 80-20. Some people use 70-30. You get a lot more signals, but there are different ways to use this. And again, the problem is now RSI is actually one of those tools that does have a statistical edge, and I've shown that in other places. If you were to trade every time the RSI goes oversold to fade to buy, you would, over the course of many trades, you would accumulate a small statistical edge. There is an edge to this tool. However, simply as you can see here, and I've highlighted the points where I think, without being really careful to make sure it lines up, I think these are the points where this market went oversold. If you had gone in to buy here, you would have a little bit of a problem. It's not enough of an edge for me to justify looking to buy. Now, let's look in terms of pure price structure. So again, there are a couple ways to look at this, but we could just draw trend lines. And there are a lot of different ways to draw trend lines. There's a little subjectivity to drawing trend lines, but what I want to do is I want to make sure that I capture this point. I want to draw to the highest swing before the market makes a new low. That's my methodology for drawing trend lines. And again, there's not necessarily a right or wrong way to do it, but that keeps me very consistent. And when this trend line is broken, as it has been here, when this trend line is decisively broken by this recent strength, that does not tell me that I should be buying this market. That does, however, tell me that this bounce is inconsistent. And we can see that with a few other ways too, right? If we look at the 20-period moving average, since this trend really got underway in late summer, perhaps in October, we've not really had much time back above the moving average. There's no magic to the moving average, but it's just a good reference point. And this is another confirmation that something is a little bit different. So what we can then look to do is what we've been telling clients in our research for many months is don't look to buy the first bounce in crude oil. perhaps we'll look to buy the second. So now we can start to look and see how the market behaves after this. We can be mindful of action back around previous lows. We can look for further upside and look to buy consolidations. So this is the first warning that something may have changed in terms of trend dynamics. Doesn't necessarily give us a buy signal. It does give us a point to pay attention. Now, another thing you will see people do is spend a lot of time analyzing, say, heating oil or gasoline, or even looking at oil stocks. And again, this is not something, this goes back with the idea of keeping this as simple as possible. If you look at 6 related markets, just by virtue of noise, or in the case, if we're looking at OIH or XLE, there is also a good component. There's certainly an influence of oil here, but there's also some equities, there's also some interest rate. There are a lot of things that play into the price here, and you have a lot more moving parts. So for me, the simplest form of analysis, and the one that has been the most useful, is simply to focus on the primary market. And that's why we're looking at crude. By extension, if you trade USO, then you can, then you need to be aware of the USO chart. But I don't see a lot of value necessarily in doing separate analysis on the USO chart. So bottom line here is we have a long intact trend in crude oil. We have just this week the very beginnings of some possible signs of trend change in crude oil, and we'll just have to see how that plays out. It is far too early to look to buy crude oil for tactical swing trades, but it is not too early to start paying attention. And as I said at the beginning of this recording, if you want more information like this, please check out my blog, adamhgrimes.com. You can also follow me on Twitter at AdamHGrimes. Thank you very much.